level. Again, property casualty insurance. I have been very, very outspoken about property and casualty because, once again, the price of real assets is going up because of monetary policy. Therefore, the insurance prices and the premiums are going up as well. To the downside, Crocs, Upstart, and Asana. Ugh, Asana. This thing still exists. Well, if you love Asana, if you love throwing bad money after bad money, Asana has been one of the largest insider purchasings over the last 5 years. Dustin Moskowitz has been buying it left and right, and it is a momentum stock. It certainly has traded with momentum, and we have seen that nice pop from $12 going back to where the squeeze started after the Japanese central bank and government announcing that stimulus. Stock currently breaking lower. If this breaks under $13.80, buying the $14 put and looking for a continuation and hopefully a retest somewhere around that $12 level. Upstart, not a fan of this company. Just have never been a fan of this company. Again, looking for continued weakness, lower highs, lower lows since August. If we break under that 20-day moving average, looking for another potential retest of that $40 level. And financials are, at the moment, breaking down. So financial stocks under some pressure. That puts credit services as potential shorts as well. Crocs is on the consumer cyclical side, but not too great. Big move down that happened 2 days ago. But if we break under that 50-day, that's the key line in the sand. 50-day moving average, 85.71. LYV, HRB, HP, and NLY. All right, so this is not a stock to trade, Annaly Capital Management. This is a alternative investment. And I know a lot of people will look at this thing and say, is that 12% dividend safe? It is. But I'm just going to warn you that when it comes to this name, it is like all of the other insurance companies. It's like all of the banks. When there is repo stress in the financial markets, these things get beat up. You see what happened back in April. You saw what happened from September, that pullback. As I've said again, though, they're going to provide support to the financial sector. So I just like NLY as an investment long term, but you have to be willing to manage it and recognize that when interest rates rise or when you start to see this kind of fiscal stress transpire, it's going to get beaten up. You have to view it for what it is, a buying opportunity, not a trade. This is not something to trade. It is simply something to park some cash in. And once again, as I continue to advocate and continue to argue, these are the types of things that if you own them, they kick off a lot of cash. This is where you can get cash to trade, and you try to turn that 12% dividend into a 50% payout by using smart trades and smart strategies, which we'll talk about in a moment. HRB has popped up as well. I haven't seen H&R Block in a while, but we will be moving toward the historically strong period of H&R Block. Why? Tax season. So right now, a couple of moving parts, selling spreads to the downside or just looking for continuation of momentum. Great stock to own into that period of the year. All right, let's see. NLY is a core holding. Reinvest the dividends. Buy more in time of stress. Exactly. Yes, you should be buying NLY when there are periods of stress. Because once again, all roads point to monetary policy expansion. All right? Cool. Great. Okay. I need to get to one thing. Now, I need to see if this screener enterprise value to EBIT. Oh, I can do that. Okay, perfect. All right, let's do it. This is your new strategy. If you go on any major financial website, if you read, people talking about, hey, these are the cheap stocks to buy, 5 value stocks to buy for 2026. You're going to see these articles everywhere. And I'm going to warn you right up front. A lot of those articles are written by people who are probably under 30 and don't have much of a deep financial background. No offense to them, but I'm just going to state that price to earnings is completely and totally worthless. It is not a metric to utilize to really fully understand the value of the company itself, particularly in this type of environment that we operate in now, where liquidity continues to expand and there's so much passive investing and there's so much leveraged, so many leveraged funds. PE does not provide an adequate figure. Yeah, what? Okay. Market price per share divided by earnings per share, right? So how much is investors willing to pay for $1 of accounting profit? So when you hear PE ratio, when you hear the Buffett ratio, when you look at the, what do you call it? The Shiller index, right? Understand this. The PE ratio is distorted by leverage. It's distorted by share buybacks. It's distorted by tax rates. It's distorted by accounting choices. The key issue is that it ignores debt. It completely and totally ignores the capital structure of the business itself. And that matters. And that's why we focus on what is called enterprise value, EV, and EBIT. So enterprise value is the market cap plus the debt plus the preferred equity minus the cash on the balance sheet. And EBIT is the earnings before interest and taxes. It is closer to operating profit. And why does it matter? Because it truly reflects the value of the entire business. It's all the capital that can be utilized at any given time. It's not just the equity. So this will treat companies like acquisition targets, not like stock tickers. When you are assessing the idea of companies that could potentially be bought out, like if you ever walk up Wall Street and you look up in those buildings and you say, what are those analysts doing? A lot of those analysts, 20-some kids, are sitting there making pitch decks. They're making pitch decks so that their bosses can travel around the country and propose that either the company sells itself or they buy somebody else. So you build these decks of potential acquisition targets and then effectively try to be the banker of the merger and acquisition analysis. That's it. That's the job. But we're not looking at P ratios when we assess this. If you are looking at individual industries, if you specialize in, say, tech software, a lot of the focus will be on enterprise value divided by EBITDA. EBITDA is earnings before interest and tax, depreciation, and amortization. Now, why does that matter? Because depreciation and amortization is tax law. So every sector operates with different tax rules. So you're comparing apples to apples when you're using EV to EBITDA. But if you're looking at all companies, apples and oranges and bananas and everything else, well, EV to EBIT is what you want to assess. EV to EBIT against private equity is much, much better because EV to EBIT compares the companies regardless of their debt. The EBIT avoids distortions from tax strategies and leverage. The buyers pay for the whole business, not just the equity. And the bottom line is EV to EBIT gives a cleaner apples to apples valuation. Now, the strategy that I'm going to name for you today and then add a little bit of a twist to it comes from a great deep value investor by the name of Tobias Carlyle. Toby wrote a book called The Acquirer's Multiple, and then he wrote another book called Deep Value. They're like this thick, and if you don't have the time and energy to read Ben Graham, just pick up a copy of of The Acquirer's Multiple. All this is enterprise value divided by EBIT. And all he's doing is he's going through all the S&P 500 and all the Russell 2000 stocks, and he's buying the cheapest quality businesses based on the takeover economics of this. And why does it work? Because the stocks are dirt cheap. And what we tend to see is when there is rotation into some of these sectors, these are the things that can take off very, very quickly. This is a form of what is known as mean reversion, right? So these are beaten down names that a lot of people are completely and totally forgetting about. And then you come to find, oh, wait a minute. There's a lot of energy names in this. There's shipping names in this. These are businesses that the people actually need. So once again, the disciplined valuation beats the narrative investing. And what's interesting about what Toby had written about was that if you looked at Warren Buffett's strategy, Warren Buffett argued that you wanted to buy great businesses at good prices. Toby went a little bit further and he said, you want to buy good companies at great prices. And that ultimately outperformed the Buffett model. So this is one of those names that I was introduced to Toby through my father-in-law, Tim. And I'm not a real true value investor by any capacity. I tend to focus more on momentum. But if you followed, our conversations about the F score and the Graham score, that is a form of value investing, quality value. And what I'm looking for on these names, there's two parts to it. The first is, if these companies have very cheap enterprise value to EBIT, well, then what do I want to do? If they have an options chain and it is very liquid, I want to sell spreads at even lower prices. I want to be able to buy this company for even less, or if the stock is cheap and it can't go any further, I'm just going to, again, focus on trying to generate a 20% return, an 80% probability of profit, and an annualized return over 100%. But if these names do start to break out, if they do start to run, then it's pretty simplistic, because all I'm doing, once again, is making sure that I am following the key momentum line, which is the 20-day moving average. So again, with the F score and the Graham score, what am I focusing on? Those names to break above that 8 and that 20-day EMA. It's the same thing with the EV to EBIT. So if we went and we assessed all of the companies in the S&P 500, and again, I'm not looking international with this, but all I'm doing is focusing on cheap names trading under 6. Now you can go to market capitalization. And aim for a $500 million name, and I'm going to explain why we want to be over $500 million. The key thing when you are assessing, what's going on here? No. Uncle Stock, the worst. 47, a lot of shipping names. Zim is on this list. Calmain, TK, a lot of shippers. Weibo is on this list. These become the names that I just want to have a basket of them, and I just want to hold them. That's all it really is at the end of the day. So once again, what am I looking to do? I'm going to go through a list like this, and these are the types of stocks that I'm going to do a qualitative analysis on, and then I'm going to look to sell spreads on those names. And I'm certainly also going to pay very close attention if there is insider buying on any of these stocks as well. And if they break above these key EMAs, they become buys, they become trades. And once again, these are extraordinarily cheap stocks. And we're just simply looking for mean reversion or capital rotation into those names. So what are we doing again? You're screening the market for the lowest EV to EBIT stocks. You apply basic quality filters, positive EBIT. You avoid financials. Because again, with financials, with banks, you are focusing on price to tangible book value. Everything else can get the EV to EBIT treatment. You build a diversified portfolio of these cheap names. And what's nice about it, you're removing all of the emotion, all of the stories, all of the growth height from all the decisions. And then you're just trading around these names, particularly in positive momentum conditions, and especially when momentum is positive in those sectors. So why does this matter for investors? PE tells a story. EV to EBIT tells a real price, the value of a business, of what an acquirer, what somebody else would want to pay to buy that company. And I want to remind you that if you are an investor, even if you are a trader, you have to recognize, you have to understand what the company actually does. And if you're going to be an investor, you need to actually recognize that you are buying a company. You're not buying a stock. You're not buying a story. You're not buying an executive. You're buying a company. And you want to pay a great price for it. And this strategy favors cash flow over hope. And the core idea is that you're buying businesses the way that smart acquirers do. And if you utilize option strategies, particularly ones that have a high probability of profit and a strong return, and I keep stressing this, if you have an annualized return on these names that is over 100%, you can make that trade over and over and over again. And rather than trying to make 100% in a day, you can make 100% over a period of a year with patience and discipline. Does that all make sense? All right. Cool. Paul, I hope that was valuable. Is there a Toby Carlisle ETF? I don't think so. I think Wes Gray does have ETFs though, and Wes and Toby have they wrote qualitative momentum? No, qualitative value. Great book. Another good book. All right. Very good. Well, it is 9:20. I'm going to go lay down for the next 4 hours. And we're going to go from there. I hope everybody has a good day. Don't get flu A or flu B. And again, we will be back live for the day. If you have not checked out Zero Date Don, right, click that link above. See Don. Let him show you how to make it pay live. Awesome presentation. And again, we'll talk more about zero date strategies later today when I'm back at 3 o'clock. Don's coming up right now. I hope you all have a great trading day. If I don't hear back from you, well, I will be back tomorrow for Market Masters at 8:45. All right, have a great day.